there is a number that nobody in Washington wants to say out loud. 8%. 8% on the 30-year U.S. Treasury bond. That number, if it ever arrives, changes everything. Your mortgage, your retirement, your country's ability to function. Right now, the 30-year yield just crossed 5.1%, the highest in 18 years. Won 208 upvotes on Wall Street Bets yesterday. The top comment, imagine getting 5% guaranteed for 30 years. Can't be me. They were joking. The bond market wasn't. This is the story of the number that could break the dollar from the inside. Before you understand the danger, you need to understand the machine. A U.S. Treasury bond is a promise. The U.S. government says, give us your money today and we will pay you interest and return your principal on a fixed date. That promise is the foundation of the entire financial world. Banks hold treasuries as reserves. Pension funds hold them for stability. Foreign governments hold them as insurance. The U.S. Treasury market, at $28 trillion, is the deepest, most liquid market on Earth. Every mortgage rate in America is derived from Treasury yields. Every corporate bond, every student loan, every car loan. When Treasury yields rise, the cost of everything rises. The bond market is not part of the economy. It is the engine room. And right now, the engine is overheating. So why are yields spiking? 3 reasons. First, the debt. The U.S. government owes $37 trillion. Interest payments alone now exceed $1 trillion per year. More than the defense budget. More than Medicare. When a borrower owes this much, lenders demand higher interest to compensate for the risk. Second, the buyers are leaving. Foreign central banks are reducing their treasury holdings. China has been selling. Japan has been selling. Saudi Arabia, as we showed you, just sold. Fewer buyers, higher yields, basic supply and demand. Third, the Iran war. Oil at $100 a barrel, inflation at 3.8%. The Federal Reserve cannot cut rates when inflation is rising, so yields must rise instead. Reddit's RR economy charts this week. 5% yields weren't a crisis decades ago because debt levels were dramatically lower. With today's debt load, the same yield becomes systemic stress. The system got addicted to cheap money, and now the price of money is becoming the problem. 192 upvotes, they understood. Now, the question everyone is asking, the question that got 126 upvotes on Reddit's bonds forum yesterday, is 8% coming? What happens at 8%? Let me show you the math. The U.S. government rolls over roughly $7 trillion in debt per year. At 5% interest, that costs $350 billion annually. At 8% interest, that costs $560 billion. An extra $210 billion per year, just in interest. Money that cannot go to the military, cannot go to infrastructure, cannot go to anything except paying the holders of the debt. Mortgage rates would hit 9%. Home purchases would collapse, the housing market would freeze, corporate borrowing costs would double, business expansion would stop, layoffs would begin. The dollar would strengthen initially as higher yields attract foreign capital, then weaken violently as the debt burden becomes unsustainable. Reddit's top comment on the 8% thread, 159 upvotes. If Treasury yields ever break 8%, I'm selling everything and going all in. Either I get 8% guaranteed for 30 years, or the currency collapses and it doesn't matter what I held anyway. That is not confidence. That is a bet against the system, made by someone inside it. Normally, when yields spike, the Federal Reserve steps in. They buy bonds, they push yields down, quantitative easing. But the Fed is trapped. If they buy bonds now, they pump more money into the economy. More money, with inflation already at 3.8% and oil at $100, means more inflation. If they don't buy bonds, yields keep rising. The government's borrowing costs spiral. The debt becomes unmanageable. This is called fiscal dominance, when the debt is so large that monetary policy becomes a servant of the debt. The Fed can no longer fight inflation without breaking the Treasury market, and it can no longer support the Treasury market without fueling inflation. Scott Bessent, the Treasury Secretary, was asked about this in a recent interview. He was called to the Situation Room mid-interview as the Iran war escalated. He called himself the guardian of the bond market. Right now, the guardian is watching the numbers with nowhere to go, and the smart money is already moving. Morgan Stanley, one of America's largest banks, is now borrowing in yuan, not dollars, yuan. When an American megabank issues debt in Chinese currency instead of its own, that is not diversification. That is a vote of no confidence in the dollar. Central banks are buying gold at crisis levels, not slowly, not gradually, at the fastest pace in recorded history. And the dollar's share of global reserves just fell to the lowest level this century, below 40%. For 80 years, the dollar was the only game in town. Now, the smart money is building exits. Not because the dollar collapsed, but because the cost of staying is becoming too high. The balance. 5% yields are not 8% yields. The 30-year was above 5% for most of the 1990s and the economy was fine. But the 1990s had something the 2020s do not. 37 trillion in debt, 1 trillion in annual interest, a shrinking buyer base, a war driving inflation, and a Federal Reserve with no room to move. The Reddit comment that got 128 upvotes this week was correct. 5% yields were in a crisis decades ago because debt levels were dramatically lower. With today's debt load, the same yield becomes systemic stress. The bond market is not predicting disaster. It is pricing in risk, real risk, that the United States government may not be able to service its debt at these levels indefinitely. 8% may not arrive, the Fed may find a way, the war may end, inflation may cool. But the direction is clear, and the direction is up. The dollar has enemies. We have spent 11 episodes showing you who they are. But the bond market is not an enemy. The bond market is a mirror. It reflects, in real time, what the world believes about America's ability to pay its debts. And right now, the mirror is showing something nobody wants to see. Yields rising, buyers leaving, debt compounding, options disappearing. The bond market is screaming. Most people aren't listening. You are. The rare earths, the bonds, the gold, they're all telling the same story. The system is under stress from every direction. Subscribe, because the next episode is the one nobody sees coming.